Hi Phantoms, happy Friday. Today I'm just going to be going over the short from Tuesday the 30th of November. Absolutely incredible short with stellar R available, looking at around a kind of 68.8 R in total, based with a 20 tick stop, so 2 pips. Obviously really nice short that I know so many of the team got involved in, as well as a lot of the members within the community, and some of you even had your best single trade to date since joining Phantom. So a big round of applause to all of you that managed to achieve that, and of course went on to smash your funding goals or your own personal goals and challenges that of course we all experience. But without further ado, let's dive right into the short on EU from Tuesday. And now we're realistically going to be starting initially just to get the narrative on the monthly time frame, and then we'll come back into the 4 hour, 15 minute and 1 minute where the execution was. So just focusing on what the monthly's offering and actually kind of providing us at the moment, we can see that we're inside this larger bearish range. Now price, since of course creating this lower high, we have seen price fail to take out this low, thus creating a weak high. And in turn, when we've come back in to fill this demand, we failed, of course, to take out this low, push to the upside, and in turn, we failed to take out this high. So in theory, as I've touched upon quite a few times now, we're still inside this range. And of course, we're creating lower highs and lower lows on the swing. So when price started to reject and react off of this particular area of supply here, price for us was realistically, if failing to break that high, coming back down to take out this low, with our first point of call being this area of demand. Now we know that this low is weak, we know this high is weak as well, so we need to establish from trading the extremes where price is most likely going to go, and we need to react from it accordingly. We need to adapt with the market conditions, and then we need to evolve and of course exploit any trades that are possibly viable based on our edge, right? Big mouthful there. So when price was inside here, shorts were obviously available. Now realistically, from shorts, after we started to create the breakdown where demand began to fail, realistically our first point of call and target point is this area of demand here, down around that kind of 110.5 handle. But if we can, of course, if this is going to be used as inducement, then this low could well be going, and of course we could be coming down to take out these lows from 2017 down around the spot 1.0330 level, maybe heading down to that parity level, which has never seen before, especially with trading view data in particular as well, so you'll struggle to see that. But jumping down into the 4 hour, focusing specifically on this area of price. Now the outlooks were dropped in the morning, and the majority of the team, including myself and many of the community members, were initially focusing on this doji top here, which of course formed that break of structure to the downside and of course continued the demand chain. Now several of us as well also pointed out the higher shooting star candle that was sitting just above this level here, which price could potentially be used as inducement for of course those higher prices for wick to be tapped into, and of course sweeping all of the liquidity. We were lucky enough that we covered it on our Tuesday Zoom call within the community, and of course we was also lucky enough that Tricky covered it in graphic form for one of the members of the community that did ask for it, and he and I were speaking about it before the drop. So hopefully this breakdown just gives you a more interactive viewpoint of that, maybe a different stance from one of the other team members, but of course you'll see that we're all in complete alignment with realistically how we view the market based on structure, liquidity concepts, of course the traditional execution methods around the chock, the flip, and then continuations based on liquidity sweeps and momentum, and of course the supply chain in particular for this short. So focusing on this level here, there was an original short placed inside here, and of course potentially around 10 are available depending on how you were viewing the market, whether you realistically wanted to take heavy partials or set price to break even, fully well knowing that realistically price could come back to revisit that area and use that previous area of supply as inducement for that higher price that was yet to be mitigated, because that realistically was the last available area for a mitigation. So moving down into the M15, this is where it starts to get a lot clearer, a lot more interesting. So hopefully you're still with me. Now, just going to the left, this is the original area of interest, this nice level here that we were looking at in the supply, and of course this was the last area that realistically hadn't been mitigated. So when price of course came back up, very corrective. Look back left again, how was price moving to the downside? Fairly aggressive, some significant volume, quite impulsive. So realistically, based on time versus price, we knew realistically that momentum was still very much to the downside. And of course, when price came into our level, what did we do? We didn't trust the first high. So just a point again, so many people do continue to get stung by this. Ay. 1 second. So never trust the first high. Yep. Sometimes we see price tap into our area of supply or demand, and of course price rockets away from that particular level in quite a formidable fashion. But something based on our own testing, edges and probabilities, we realistically believe that the first high is used for inducement and it's going to be swept, and if it goes without us, so be it. You know, there's so much on offer on the markets on a weekly basis, let alone a daily basis, that we can be quite precise with what we want to do. We can be as patient as we need to, because we realistically know that when the market does what we want it to do, we will adapt, we will evolve, we will execute accordingly in line with the model, the edge, and all of the education that we provide to you on a weekly basis, as well as, of course, the original refined content as well. So price did come into this level. We then, of course, built liquidity, pushed to the downside. We swept this liquidity here to fuel that move to the upside, and we swept liquidity to the upside. We did push down. Now, of course, in terms of reaction, we've got the sell to buy wicks here that price did then react off of to push higher again and take out that level above, which then gave us that incredible sell-off, and for some of you, probably life-changing trades. But obviously, price reacted off of this, pushed to the upside, used this high as inducement. And then we started to see that model, of course. Now, just look at how beautiful those two M15 candles are. Again, what did it react off? There's a nice kind of level inside here on the M5. So we'll take a look at that as well in a second. But there's obviously a lot of liquidity that it took out. So that's one thing to note, right? We've got all of this internal range liquidity that was taken out from that move. Now diving down into the M1, just so that we can start seeing the model of how we actually get into our trades, which should be clear to all of you now, because of course you've seen an abundance of material being dropped across the refined content, and of course the specific and bespoke channels around what is chalk, what are flips, and then of course the theorem of liquidity and inducement, as well as the supply chain and demand chains, of course, that we all cover through Blackwatch, Tricky, and the likes as well. Now, the original short that I was referring to is here. Never trust the first high. We can see that we created equal highs. We've then pushed down, started to take out structure. Wicks showed us that the low was obviously looking there to be swept, pushed back up to the upside, and then we've created that chalk, push to the downside, and continuation. Now, what didn't we have originally? Then you could have said there was a flip inside here and maybe tried to get something inside here on the second, but it wasn't that clear, nor was it clean. And we like to try and recommend not necessarily moving down into the seconds, because you don't need to. There's enough R available on the M1 time frame and above for you to not stress and be a prick over every single tick that's in the market. Now, once we saw that kind of flip move into the market, price, of course, did give us that ability to get involved. Where did it come off of? This inside bar held. It then failed. The failed reaction got taken out, and then we pushed back in. So nice 10R available. In terms of what we would have managed, in terms of how you want to manage this trade, is this going for the lows? Realistically, no one knew, or no one knows. But how do we manage this trade once we're in it? So once price broke this low here, you have a couple of options. Are you moving stop to break even plus spread and commissions, just to factor in that you really want to be zero loss on the trade if it were to come back and take you out, but knowing that sometimes price likes to come back to retest and do a second drive, second mitigation into a supply or demand level, you could have been taken out, but you would of course protected your pad and of course protected your downside. Alternatively, when price got down to here, you could have heavy partialed, and then you could have been looking to take some profits along the way based on these kind of levels here of demand, which none of them are majorly significant, but you can see all of them have caused some form of reaction. You know, we've got this area of demand here. What did it do? It took out this higher, took out this higher, and of course push prices continued higher. We had a reaction off of this area of demand here, and again, these aren't significant areas of demand. They are just demands that realistically are going to be used for inducement, because they are considered as internal range liquidity. So all of this is realistically going to be used as void places for price to react and then push to the downside. So what they tend to do is you'll get price reacting. So if I just pull this to the right, you'll get price reacting. You'll get a lot of people trying to build long positions from this internal range, looking for price to come back up to take out this high because they're seeing it as well. This high's gone. They don't really understand that we've then chocked, pushed to the downside, taken out this low, and they still realistically think we're bullish. Built liquidity, pushed to the upside, and then of course all we've done is we've reacted and failed. So now this demand's been taken out. So the supply chain has been created because demand is continuing to fail. So realistically on offer, obviously, depending on how you've taken this trade, you would have either moved away with a break even, or you potentially could have got away with the kind of just over 8 3/4 are. So really nice trade. And then we push back to the upside. So moving back out to the M15 very quickly, just to show you this. We pushed to the downside, reacted off of these sell to buy wicks, as we saw there was a nice little area of demand there. Pushed back to the upside. We've taken out this high. We've now swept this high. And of course, this is where that gorgeous sell-off comes in. So let's move down into the M1 again. So we've had a sweep of the liquidity. Obviously, intentions are still remaining bearish based on a higher time frame narrative, as we've touched upon earlier in this trade recap, and of course, all in the content that's been covered this week, specifically around this trade in the community call and the graphic created by Tricky, specifically looking at the liquidity theory as well. Now, price came into this higher time frame H4 level. We've taken the higher, we've taken the low. We flipped off of this level here, pushed to the downside, demand has failed, we've come back in. Now, something that you'll have noticed is, why did I take my execution here? Now, the only reason is because I like to have a minimum of a 2-pip stop. Of course, we can refine that down on the seconds to see what specifically it tapped into within this wick here, which you'll find. But as long as I and some of the other team can get a 2-pip stop, which is 20 ticks based on TradingView, then I'm happy. Now, this could have gone without me, because if we actually look at the size of this, you know, it's 4 pips, which again, it's not something that we turn our nose up at, nor should it be something that puts you off a trade. If you can get into a trade with anything underneath 10 pips, if you're swinging on the M15, 10 pips is substantial regardless. You know, you can get in with a 4 or 5 pip stop. But if you can get in most trades without a 10 pip stop and smack 5 to 1 RR, 1 to 5 RR, depending on how you guys say it and girls say it, you know, you're walking away with 5% per trade with a significant strike based on the methodology within Phantom. So I always will realistically look to take a trade with a minimum of a 2 pip stop, and I'll always try to place my RR, my execution, my sell limit around that particular area to make sure that I cover the highs. I always want to cover the high of any trade. So for me, 2 pip stop was here, allowed me to cover the high with a significant amount of room above it. And of course, as soon as price tapped into that, it never really came back. Now, what you'll notice is as price started to push to the downside, when we took out this area here, dependent upon your own personal trade management on the plan that you have, there's two options for you now. You would have realistically taken partials, or you would have moved your stop to break even. Either one of them is fine, and in this particular scenario, you would have been safe. You would have stayed in the trade regardless of what happened next. Now, price then pushed back up, created inducement, and then we broke to the downside, taking out this level here, and then we came back in. Now, some people I did see getting in this short from this particular level, and of course, pretty significant move to the downside. And it was pretty much over half an hour. Price continued to move, taking out all of the demand from the internal range liquidity to the left. Now, had you have stayed in the first trade and actually taken full risk on this trade at 1%, you would have been running at 68.8 as we tapped in to this significant area of demand. So realistically, you would have walked away with around a 68.8% trade. Had you have obviously taken partials, then of course, dependent upon how aggressive you were with your partial taking, then, you know, realistically, you're probably looking at between 40 and 50%, which again, still an absolutely incredible move. I know some people traded on half risk and they banked around 24, 25%. Again, absolutely incredible R in consideration of time versus price and actually what you used to achieve. Obviously, this trade was absolutely stellar. And had you have got involved based on this level here and just covered the higher, you're realistically looking at kind of like a 5 pip stop. Nice 27R available. Let me just tighten that up a bit. Just under 27% available in that particular trade. Now, if you were to do 0.5%, you're looking at more like 13.5% on that trade. So again, really, really nice trades. The same thing happens over and over again. There's nothing within this particular trade here that we haven't covered in all of the recaps, in all of the weekly content, in a lot of the content that we discuss in a daily basis within questions, what's chalk, what's flip, in the weekly zooms that we cover as well. So there's nothing new or nothing different that any of the coaches are doing or any of the team members are doing. It's the simple applied methodology that we run through on a daily, weekly basis. We know it like the back of our hand and we've tested it daily. Something that obviously I know that a lot of members of the community are struggling with is end of day markups. And all realistically we're doing when we do our end of day markups is we're going through that day's price action on the 4 hour, the 15 minute, the 5 minute and the 1 minute, and looking at all of the available opportunities and marking them up. Now, once we've marked them up, you have a couple of opportunities and a couple of choices. Of course, once you've documented them and noted them and journaled them within your particular journaling tool, be it Notion or whatever you may be using, you then have the ability to go back over price and look at how price actually reacted, how price played into it, what your emotive state is, even be it in the backtesting kind of methodology and the mindset that you're in, the framework. You want to make sure that you understand your psyche and you want to understand how you were feeling in that particular moment when you got involved in that trade, when price came back into that particular area. Were you second guessing whether that was the chalk? Were you second guessing whether it was a flip? How did you know price was going to react off of this particular level? How did you know price was going to react off of this particular level? How do you know price wasn't going to hold this demand? There's a lot of different things that only through action you're going to be able to answer. Now, we can give you a lot of the answers ourselves, but like everything, unless you do it yourself, you're never going to gain that subconscious and conscious experience, that knowledge, that peace of mind that all of it works consistently and the edge is actually available to you on a daily or weekly basis across whatever pair you may trade. So just bear in mind that these trades, nothing, how we get involved in them, how we execute, how we prepare ourselves, pre-sessions, both for London and New York, nothing changes. There's no hidden source. We do the same thing over and over again. Now, diving back in just to the M1, just to show you on this particular short, it's just about trusting your edge and knowing your edge. Price came in, we took the high, we took the low, we flipped off of this level here, We then came back in, and at this point, market execution as price was coming back in. 20 ticks, 2 pips covering the high, giving ourselves ample room for potential slippage and of course potential moves of aggression. Price then of course came down, broke structure again, and then pushed to the downside. Now, if you wanted to be a little bit more conservative, you could have waited for that supply chain and of course for demand to continue to fail. So we had this area of demand fail. We then had this area of demand fail. We then had this area of demand fail. And all we've been doing is building liquidity, right? Taking out all of the internal range liquidity to our left. Breaking structure, pulling back, coming back in realistically to that last area of demand that we took out. Breaking structure, coming back in. Inducement, fueled liquidity, last point of mitigation, price has come back in, reacted and moved to the downside. So had you wanted to be a little bit more patient rather than taking a more aggressive approach based on of course one of the first entry models, then you could have been looking for demand to fail, that supply chain continuation and of course liquidity in theory coming in, and then you could have got short there, which offered you again significant R. And had you have wanted to scale into that trade, you know, you're looking at what, 70, 96 roughly. So 95 are rounded probably. Would have been quite comfortable just over those 2 trades. So I hope you've enjoyed the trade recap. Feel free to drop comments. Feel free to ask any questions within the community Discord, or feel free to direct message me as well. But I hope you have an incredible week. Hope you have an incredible weekend, and look forward to catching up with you after non-farm payrolls.